Welcome to Beyond the Numbers, the podcast that explores the human side of financial planning and investing. I'm Oliver Wickham, Partnership Director for St James's Place Asia and Middle East, and today we're talking about something that affects every investor at some point: volatile markets. When markets swing up and down, it's natural to feel anxious or even tempted to make quick, impulsive decisions. But often our instincts can work against us. Investors too often end up buying high and selling low, and that's where behavioural finance comes in, helping us understand why we react the way we do and how to stay disciplined for the long term. Joining me today is Giles Henman, Senior Partner of St James's Place and Head of Business at 8 Wealth International. Giles has decades of experience guiding clients through turbulent times, and he's passionate about helping people make better decisions and avoiding costly mistakes. Giles, welcome to the show.
Good morning.
Maybe you could start by just sharing a little bit about yourself and who your typical clients are and how you help them.
Yeah, sure. I've been an international financial planner since 2012. Joined St James's Place in 2014 back in Shanghai, where we worked together there. I love working with traditionally more senior British expats, but people that need financial support, financial help. And I like to be that go-to person in somebody's lives when they reach those sliding door moments.
Okay. And financial planning versus financial advisor, what's the difference?
Well, financial planning is just that. It's planning for the future. It's creating a plan that clients can buy into, that they believe in, that gives them that reassurance that they're actually on track to meet their financial objectives. It's not just about investment advice. It's a big part of what we do. But financial planning is far wider than that. And as I said, it brings the comfort factor.
Okay. So if we look at your approach with clients, you said that you tend to work with British expats. I've got, I'm sure, other nationalities as well.
Absolutely,
I've got no doubt with expats brings extra complexities perhaps than somebody that lives in their home country. But can you talk to us a little bit about the approach that you take with them? Financial
planning starts with the hard facts. So it's important to obviously understand where a client is today, but more importantly, it's around the soft facts. It's getting to know a client, their ambitions, the things that are important to them, their future goals. Sometimes the clients don't actually know some of these things, or they think that they don't know. So very much the initial approach is lots of open questions and really understanding what the drivers are. You've got to have a genuine interest in people to do this job, but it's the part of the job that I like best, really getting to know my clients and as I said, understanding their drivers. From there, it's about creating a plan, linked to their future aspirations and goals. So things like the obvious things like retirement and education planning, but there's lots of other aspects to that as well. And once we have an idea of what clients are moving towards, it's about creating financial objectives around that and very much reverse engineering where they want to get to versus where they are today and creating a plan.
Okay, so when you mentioned reverse engineering, it's almost looking at their retirement. You mentioned earlier, where are they going to be, how much income do they need for themselves, their family, etc., and then you're working backwards to today, which for some people could be 5, it could be 25 years away.
Yeah, absolutely.
And working out how to put that plan in place.
Yeah.
So it sounds like it's very much about actually staying on track for the bigger goals. It's having a plan versus looking at daily headlines that come up.
Yeah, I think we live in a world where news is delivered to us very fast. Sound bites move markets. Politicians are very clever at saying certain things that might have a big impact on the markets, intentionally or not, depending on which way your viewpoint is. But if you're focused on long-term future goals, then the short-term noise becomes largely irrelevant. It can be scary, but it's largely irrelevant to the overall objective.
And that's difficult, right? Because we're in a world where you can pick up your phone and you can press into whether it's your banking app, your trading app, your wealth management app, and you've seen the market's gone up or down, and people like to be impulsive and press buttons. How do you manage that as an advisor?
Well, I think this is the most important part of working with advisor. I see very often people that self-invest make knee-jerk reactions to market movements. They either, all those emotional biases, the bad emotional biases kick in: greed, jumping on the bandwagon, being fearful, and when markets are dropping, and moving out of markets just at the wrong time. So it's about the setup, making sure that you're set up in the first instance in the right way. And as I said, the objectives are set to longer term goals. Being in the right portfolio. I always talk to clients about it must pass the sleep at night test. You don't want to wake up in the middle of the night in a cold sweat worried about your investment portfolio. And I do have the odd phone call when markets are their most volatile, but it's about reassurance. I think that's the importance of working with a financial planner or a financial coach, just making sure that people are reminded why they're investing. And it's not for the valuation today, it's for the valuation 5 and 10 years from now.
Okay. The sleep at night test, I love that. If it's keeping them up at night, then they're probably in the wrong portfolio investment. But how are you agreeing with them at the beginning how you're going to manage all of the noise around? Because you can't avoid the headlines these days, can you?
Well, I think absolutely. I mean, I think at the beginning it's about having an honest conversation around why investing in markets is good. It's a certain level of risk above investing in cash that will give you the returns. It's not a straight line. Markets move up and down. Good investment managers use that volatility to their advantage. So markets will move up and down, and it's making sure that a client understands that. And if they're not comfortable with a certain level of volatility, then they're in the wrong portfolio at the beginning. Okay. Now, that's where having a goal in mind is important. If you know that you need X 20 years from now, very, very simple to reverse engineer that, factor in inflation, factor in potential market movements to work out what you need to invest today or what you need to save on a regular basis. So taking the right level of risk can be driven by the plan. And often I see clients when I meet them for the first time, they're taking too much risk and based on what they're actually trying to achieve. And in other situations, not enough risk.
Yeah. And you've obviously mentioned the word risk a number of times then. It's how do we get clients, or how do you get clients to understand that we talk about risk tolerance, but what is it?
Well, there's different types of risk. I mean, going to the casino and putting it all on black is one type, or being all invested in one company. And there's a huge amount of concentration risk there. When we talk risk, we're not talking about the risk of losing all of your money. We're talking about the journey, how much volatility, the peaks and the troughs along the way. Risk can be managed. Time is a huge mitigator for risk, as is diversification. So something that a goal that's 5 or 10 years from now, or a portfolio that's targeted at your retirement 20 years from now, can be managed through active management, good diversification, making sure that you're not over-concentrated in any one market or sector, and certainly not one company. And it's about a belief that the world is going to be a bigger and better place 10 or 15 years from now.
That's interesting. It's about that belief that things are going to grow. It sounds like it's also about managing expectations as well, very much so, because people don't like surprises, do they? And therefore, if they've got an understanding markets are going to go up and down, actually when it goes down, that presumably creates some opportunity as well.
Yeah, I mean, the first thing I do is, by the way, with clients is not take all the credit if they've had a really good year. We've had two or three good years of market returns, and I certainly don't pretend that it's all about me. We have a huge investment machine that sits behind us, and our job is to get as much of the upside in any good market as possible and manage the downside risk. But I'll also always talk to clients about the fact that even if you had a good year this year, there's potentially going to be more difficult years moving forward. It's just a reality of the market, and a client needs to be fully aware of that. But the other thing I would say, Oliver, is that there's also a risk of not investing, particularly at the moment, sitting on too much cash at the moment, the danger of inflation. Again, I always talk about that a bit as a death from a thousand cuts. You know, you don't actually notice that the value of your cash is diminishing, and the buying power of that becomes an awful lot less. So there's a risk in doing nothing. There's also a risk, obviously a considerable risk of not saving at all. So it's getting that balance right between having enough cash on deposit today, enjoying life today, but also saving for the future.
So if you sat with a client and they're perhaps the client that is either taking that first step because they've never invested before, or perhaps they have invested but they've come out of the market and they're on cash at the moment, how much of it is about market timing versus time in the market?
It's all about timing the market. Market timing can have an impact in the short term, but actually when you extrapolate market returns over a 10 or 15 year period, you don't really see the peaks and the troughs. You see them over a short period of time. That said, if I looked at 2020, the year that COVID hit the world, investors that did particularly well are those that perhaps took a little bit more equity risk towards the bottom of the market. It's always difficult to predict the bottom of the market, but we had a sharp drop over the space of days, and those people that took a bit more equity risk. But again, you have to go into that eyes wide open, and that's about having somebody that you can work with, that you trust, effectively a financial coach that can talk to you in very pragmatic terms, the advantages and disadvantages of any approach you might take.
And this is one of the challenges, I guess, isn't it? Obviously, none of us can see the future. None of us can see what are going to happen in the markets. And often if we try to predict it, we'll get it wrong.
Yeah.
I remember back in Brexit where, the UK came out of Europe and everybody thought markets were going to tank. So many people withdrew money. And then, of course, what happened was the pound weakened so much that it became very attractive.
Yeah.
And the bounce was huge. And so many people missed out on that because of trying to time the market.
Yeah.
How do you mentioned cash flow modelling earlier. How do you try and factor in some of these scenarios, some of the unknowns?
Yeah. Well, to your point, by the way, first, I do get very frustrated with the YouTubers and the doomsday merchants. I mean, if you predict the end of the world enough times, you're going to be right at some
Eventually.
point. Yeah, absolutely. And the reality is what we try and do is navigate through all of the turbulence and take a middle of the road approach. And over time, that generally works out better. But when it comes to cash flow modelling, I have some clients with some very sophisticated spreadsheets, some impressive spreadsheets that I couldn't build. But what they can't necessarily do is factor in the what if. So the cash flow modelling softwares that we use, and we're very active with our clients in terms of making it very central to our proposition, factors in things like inflation. It factors in various different historic growth rates, real-time growth rates over time, based on the level of risk that one wants to take. And then what we can also do is then factor in financial shocks. So, for example, a 2007, 2009 style financial crisis. We can factor that in at different times at one's retirement, leading up to one's retirement, even if you wanted to, a big shock to the system the year before you're due to retire. But again, this is where good financial planning comes in place. And when I talk about time being a huge mitigator for risk, the best time to be taking risk is 15, 20 years out from retirement. And what you shouldn't be doing perhaps is trying to catch up a year or two before you're due to retire. That's the time where ideally you look to take risk off the table. You consolidate the efforts you've made over your lifetime, and you take less risk at that point. And then when you go into retirement, the strategy is different again. You're looking at different types of risk, like sequencing risk, this idea that if the value of your assets falls the first year of retirement, your money's got to work much harder for you. So it's managing those types of real risk at different times of your financial journey.
It's complicated, isn't it? It sounds like it's just important to actually have you described yourself as a coach, really have a financial coach to have these discussions with.
Yeah, I think it's about keeping clients honest. So once you have a plan, I relate it to getting fit, losing weight. We set a goal on the 1st of Jan, we're going to do this, we're going to do that. And sometimes 3 or 4 months in, it's all been forgotten. So my job through a regular review process, through creating that plan, is to make sure that we meet regularly. We review against objectives, and we make sure clients stay honest. And I think people appreciate that.
I was about to ask you, actually, accountability has to be key, because everybody, I think, was it Mike Tyson that says everybody has a plan, and then you get punched in the face,
Yeah.
and things change around you. So you sit and work really hard. You put a plan together that everybody buys into.
Yeah.
How do you, the word you use, keep them honest or accountable to that plan? And do clients really stick to it?
I think they do. Actually, there's a huge power in setting longer term plans and objectives, not just with financial planning, with every aspect of life. And I think we need purpose in our life, and I think we need targets. The bit that I then do is make sure that I'm a constant in a client's life. I like to be that person that they come to first if they've got those turn left, turn right moments in life. And being that person that can remind them why we put a plan in place. And as their life changes, or as the external environment changes, we live in a world now where taxes are getting higher. Politically, things are quite interesting at the moment, let's say. So my job is to keep an eye on that and make adjustments when required, but obviously keep an eye on the changes in clients' lives as well, and adjust the plan to suit. And I think that's the undervalued value in financial planning and working with a financial planner, that sometimes the DIY guys or the people in the press just don't necessarily understand.
Yeah. It sounds like it's all about trust and relationships. How important is that advisor-client relationship?
It's incredibly important. It's the bit that I enjoy most. I think a good financial planner has to be a giver rather than a taker. They have to care about people. I think that comes across one way or the other. If you're not that type of person, a client can soon work that out. A lot of my clients are also become very good friends. It's a huge responsibility to work that way as a financial advisor, because you are responsible for clients achieving their future objectives, and I take that responsibility with a great deal of pride and care. I think if you don't, you're in the wrong job.
Yeah, fantastic. Okay, Giles, we've covered so much there. It sounds like this is about having a long-term plan. Cash flow modelling is a really useful tool for you to help people stay honest and accountable to themselves, and stay on track. Most importantly, advisors need to truly care about their clients and the relationships. If you could leave our listeners with just one more piece of advice before we finish the show, from all your decades of experience, without giving your age away, what would that one tip be?
Well, I mean, without sounding like a broken record, it probably is to make sure that you have a plan. I would always say work with a financial planner, work with a financial coach that you trust. Focus on the long term. Don't be diverted by short term noise or volatility, and enjoy the journey.
Fantastic, Giles. Thank you so much for joining us today. It's been really great to hear your insights. I think what stands out is that investing isn't just about markets or numbers. It's about behaviour, discipline, and having the right support so you can stay calm when others panic. For anyone listening, if this conversation has resonated with you, please share it with your friends, colleagues, or family. And if you'd like to learn more about how St James's Place and Giles can help you plan with confidence, please do get in touch. Thank you for joining us on Beyond the Numbers, putting the human side of financial planning first.